Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Carrier Global Corporation Annual Report. Carrier Global Corporation offers a wide range of businesses and services to meet the climate and energy needs of residential and commercial customers worldwide. The company operates through 4 segments: Climate Solutions Americas, Europe, Asia Pacific, Middle East and Africa, and Transportation. The company provides various products and services including air conditioners, heating systems, heat pumps, home and building energy management systems, automation systems, aftermarket components, repair and maintenance services, rental services, modernization and upgrades. These solutions cater to the needs of residential and commercial customers for heating, cooling, and ventilation. In addition to these climate solutions, Carrier also offers transport refrigeration and monitoring products, services, and digital solutions for various applications such as trucks, trailers, shipping containers, intermodal, and rail. The company's diverse portfolio is offered under several brands including Carrier, Viessmann, Toshiba, Automated Logic, Bryant, CIAT, Day and Night, Heil, NORESCO, Carrier Transicold, and Sensitech. Overall, Carrier Global Corporation provides a comprehensive range of climate and energy solutions to meet the needs of various customers across different regions. The stock price of Carrier Global Corp has remained relatively stable over the past year, with no significant changes in daily movements exceeding -0.25%. This stability can be attributed to a lack of major market-moving news or when various positive and negative factors are balanced. An analysis of specific dates reveals that even on days where the stock experienced slight fluctuations, there were no distinct news announcements or events that directly caused this minimal movement. The absence of significant price changes suggests that the market has already factored in existing information, indicating a lack of new developments to prompt substantial price shifts. However, one notable exception was the release of Carrier Global's fourth quarter and full year 2025 earnings report on February 5, 2026, which resulted in a 3.03% decline in shares due to missing analysts' consensus estimates for both earnings and revenue. The stability of Carrier Global Corp's stock price over the past year can be attributed to a combination of factors, including a lack of major market-moving news and the balancing of positive and negative factors. The absence of significant price changes suggests that the market has already factored in existing information, indicating a lack of new developments to prompt substantial price shifts. Carrier Global Corporation market capitalization of $53 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Carrier Global Corporation holds a significant advantage in their industry. Carrier Global Corporation trades at a higher price-to-earnings ratio of 37 times and a higher price-to-book ratio of 3.82 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 62% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, the sale of products to customers is a significant contributor to revenue growth. Additionally, installation and service contracts provide a steady stream of income. Incentive programs, such as reimbursements to distributors for promotional pricing, also play a crucial role in driving revenue growth. Furthermore, secular trends in intelligent, integrated, and sustainable technologies have created opportunities for the company to expand its revenue base. This includes the sale of heat pumps, boilers, photovoltaic systems, home battery storage, and digital solutions. Operational synergies, such as supplier rationalization, reduced manufacturing costs, and lower general and administrative costs, also contribute to revenue growth. The expansion of service revenue is another key driver of growth, as well as the leverage of distribution channels and cross-selling opportunities. These factors have enabled the company to increase its revenue over time. On the other hand, revenue decline can be attributed to several factors. Divestitures, such as the sale of Access Solutions, Industrial Fire, CCR, CRF Business, and Riello Business, have resulted in a significant loss of revenue. The decrease in contract assets and net contract liabilities has also contributed to revenue decline. Overall, the company's revenue growth is driven by a combination of product sales, installation and service contracts, incentive programs, secular trends, operational synergies, service revenue expansion, distribution channel leverage, and cross-selling opportunities. Conversely, revenue decline is primarily due to divestitures and changes in contract assets and liabilities. The net income of the company underwent significant fluctuations between 2024 and 2025. Initially, it decreased by a substantial 74% from $5.6 billion to $1.48 billion due to various factors such as volatile exchange rates, changes in local government regulations, and uncertainty related to trade policies and tariffs. However, despite these challenges, the company managed to increase its net income by $71 million in 2025 compared to the previous year. The profit margins of the company also experienced a decline, decreasing by -6% from $5.98 billion to $5.62 billion. This decrease was attributed to volume reductions in certain end markets and higher selling, general, and administrative expenses. Furthermore, the company's gross margin decreased due to increased costs of products and services sold. The reasons for these changes are multifaceted and include external factors such as volatile exchange rates, regulatory changes, and trade policies, as well as internal challenges like product quality issues and litigation risks. However, the company has implemented mitigation strategies such as supply chain adjustments, productivity initiatives, and price increases to address some of these concerns. Despite these efforts, the company's net income and profit margins continue to face significant headwinds, highlighting the need for sustained focus on cost reduction and restructuring efforts. The company's financial performance indicates a significant milestone. According to the provided information, the company has successfully transitioned into generating positive operating cash flow. This achievement signifies a substantial improvement in its financial health, allowing it to cover its operational expenses without relying on external funding. This development is a testament to the company's effective management and strategic decisions. The ability to generate positive operating cash flow demonstrates that the company's revenue streams are sufficient to support its ongoing operations, reducing the need for additional financing or debt. This trend bodes well for the company's long-term sustainability and growth prospects. The company's debt level has undergone significant changes over the past year. Initially, it stood at $12,362 million in 2024, but decreased to $11,833 million by the end of 2025. Indicating a reduction of $529 million. Furthermore, long-term debt also saw a decrease from $11,026 million in 2024 to $11,365 million in 2025. However, another report shows that it actually increased to $11,473 million, suggesting some inconsistency in the data. Despite these discrepancies, one thing is clear. The company's interest expenses have decreased significantly. According to reports, there was a 21% drop from $580 million to $458 million. Additionally, interest expenses also saw a decrease from $31 million in 2023 to $28 million in 2025, indicating a consistent downward trend. The performance of various segments and regions within the company's operations has shown some notable trends. Internationally, the company fared better than domestically, with a higher sales percentage of 52% compared to 48%. This suggests that international markets have been more lucrative for the company. In terms of specific regions, the United States operations saw an increase in external sales from the previous year, indicating growth and success in this market. Conversely, Europe and Asia-Pacific regions experienced a decline in external sales, which may indicate challenges or difficulties in these areas. On the other hand, other region reported an increase in external sales, suggesting that it has been a bright spot for the company. Overall, while there are some regional variations, international operations have generally performed better than domestic ones, and certain regions such as the United States and other regions have shown growth. Management is optimistic about the company's future prospects despite facing various challenges. They plan to focus on cost optimization and market conditions to mitigate the impact of these factors on sales and earnings. A key strategy is to invest in strategic initiatives such as digitalization, electrification, and product position, strengthening to create long-term shareowner value. The company aims to transform its portfolio into a pure-play climate and energy solutions provider through acquisitions and divestitures. This will enable it to focus on providing differentiated, digitally enabled lifecycle solutions to customers. Management is also committed to developing intelligent climate and energy solutions with significant investments of over $4 billion by 2030. In addition, the company has set ambitious sustainability goals, including achieving carbon neutrality in its operations by 2030. This demonstrates a commitment to environmental responsibility and social accountability. Overall, management's strategy is centered around innovation, digitalization, and sustainability, positioning the company for long-term success and growth. The acquisitions and divestitures made by the company are significant events that have shaped its portfolio over time. On the acquisition front, the company has made several notable purchases. One of the most recent acquisitions is VCS Business, which was acquired on January 2, 2024. Another major acquisition is Kidd Fire Fighting, Inc. KFI, which was initially acquired by a UTC subsidiary in 2005 and later merged into KFI in 2007. However, in April 2020, the company separated from KFI once again. The company has also made significant acquisitions in other areas, including Carrier, which was acquired as part of its portfolio expansion. On the divestiture side, the company has disposed of several businesses, including Access Solutions, Industrial Fire, CCR, and CRF Business, all of which were sold off in 2024. Additionally, the company is currently in the process of disposing of its Riello business, pending further developments. Furthermore, the company had previously divested its AFFF businesses to an unrelated third party in 2013. The separation of Carrier's business from UTC is also a notable example of a divestiture made by the company. The company has demonstrated its commitment to returning value to shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts over the past few years, with a total payout of $772 million in 2025 and $670 million in 2024. In addition to paying dividends, the company has also engaged in substantial share buyback programs. In 2025, it repurchased 114.9 million shares for $6.8 billion, while in 2024, it spent approximately $1.9 billion on share purchases. These efforts demonstrate a clear intention to reduce the number of outstanding shares and increase earnings per share. The company's dividend payments and share buybacks have been consistent over the past few years, with only minor fluctuations in the amounts paid out. This suggests a long-term commitment to returning value to shareholders and investing in its own growth and development. There are concerns about inventory buildup and supply chain disruption. The main causes of these issues include periodic disruptions in supply chains, higher freight and logistic costs, supplier capacity constraints, quality issues, disputes, or production disruptions. These problems can lead to shortages of materials, increased transportation delays, and higher costs for fuel and freight. Additionally, the imposition of tariffs or additional sanctions could further affect the supply chain. For instance, a military conflict between Russia and Ukraine may result in significant disruptions to global trade. The data suggests that inventory levels have been fluctuating over the past few years. In 2023, there was an increase of $123 million, followed by a larger increase of $292 million in 2024. However, in 2025, inventories decreased by $81 million. Despite this decrease, the overall value of inventory buildup is still significant, with a total value of $948 million. Overall, these concerns highlight the need for companies to carefully manage their supply chains and inventory levels to mitigate potential disruptions and costs associated with inventory buildup. That concludes the financial summary for Carrier Global Corporation. Feel free to comment below, and I will be happy to answer them when possible.